Checkpoints is presented by pharmaceutical company GM Pharma.
As the world nears the midpoint of what was intended to be a transformative decade for development, the global economy is set to rack up a sorry record by the end of 2024, the slowest half-decade of GDP growth in 30 years, according to the World Bank's latest Global Economic Prospects report. The Checkpoints interviewed Ayhan Kose, the World Bank's Deputy Chief Economist and Director of the Prospects Group, for more in-depth analysis. According to the World Bank, by one measure, the global economy is in a better place than it was a year ago. The risk of a global recession has receded largely because of the strength of the US economy, but mounting geopolitical tensions could create fresh near-term hazards for the world economy. Meanwhile, the medium-term outlook has darkened for many developing economies amid slowing growth in most major economies, sluggish global trade, and the tightest financial conditions indicates. Global trade growth in 2024 is expected to be only half the average in the decade before the pandemic. Meanwhile, borrowing costs for developing economies, especially those with poor credit ratings, are likely to remain steep, with global interest rates stuck at 4-decade highs in inflation-adjusted terms. Let us hear more insights from Ayhan Kose, the World Bank's Deputy Chief Economist and Director of the Prospects Group. Mr. Ayhan, welcome to the show, and thank you for taking your time. The global economy is set for the weakest half-decade performance in 30 years. This is the major headline of the report. If we could break the report down into good news and not so good news, what would be your major highlights?
There are some good news, and the good news are that when you think about the multiple shocks global economy has experienced over the past 3 years, we have not seen a major crisis. We have not seen a significant downturn in the global economy. There is still growth. Growth is going to be there with us. Last year it was 2.6%. This year it's going to be 2.4%. At the beginning of last year, many people expected the US economy to have a serious downturn. US has been very resilient, and thanks to the US economy, thanks to robust growth from India, Indonesia, Mexico, Brazil, we ended up, growth around 2.6%. This year, we will see slower growth, but the likelihood of soft landing has increased. So these are all good news. Not so good news is that still, when we look at the overall growth performance, since the beginning of this decade, from 2020 to 2024, it is going to be the weakest average growth for the global economy we have seen half a decade since the early 1990s. And, when you think about the global trade, last year global trade growth was nearly zero. This year it will pick up a little bit, but still will be much weaker than what we saw in the decade prior to the pandemic. And when you think about the external environment, developing economies are facing beyond global trade, financing conditions are still quite difficult. Real interest rates are quite high. Geopolitical tensions have been rising. So there are many reasons to be concerned about as well.
So what is the main reason for the anti-record, as the World Bank called for this economic growth slowdown in this decade? Are we losing to COVID-19? Is it the main reason why this happened?
So we ended up with the weakest half-decade growth performance because of a variety of reasons. When you think about the number of shocks global economy has been buffeted with, starting with, of course, the pandemic, then inflation shock, the real interest rates going up significantly in a very short time period, and then, of course, we had the Russian invasion of Ukraine, and then now we have a major conflict in the Middle East. All of these things were taking place against the background of very high debt levels and really very weak growth of world trade and very weak growth of investment in many countries. So you sum up all of these, you end up with, unfortunately, an unpleasant outcome. The weakest growth in half decade we have seen since the early 1990s.
The World Bank in its report says that this decade should have been a transformative one. Why, what was so transformational about this decade, and what are some of the harshest impacts on this transformation from this global slowdown?
We were hoping by the end of this decade to make significant progress in getting close to sustainable development goals. Those goals were set, almost 10 years ago with the idea that we were going to eliminate extreme poverty. We were going to reduce greenhouse gas emissions. We were going to make significant progress in terms of health service, in terms of education outcomes, in terms of inclusion, and when you think about the broad progress, we haven't been able to make enough progress. And progress requires economic growth in terms of, increasing investment, in terms of basically providing the necessary education, necessary health services, overcoming the pandemics, epidemics, these contagious diseases. Of course, with multiple shocks and weak growth outcomes, and we ended up with a sorry record.
If we take Green Agenda specifically, is it a challenge nowadays or an opportunity in this situation? Because I've read several reports that claim that sticking to the agenda will accelerate the global economic slowdown. What is World Bank's take on that?
We think Green Agenda provides enormous opportunities, not just for advanced economies, for developing economies as well. Energy transition is necessary when we think about the impact of climate change, not just, in certain parts of the world, but pretty much every corner of the world, in terms of the frequency, in terms of the cost of climate-related natural disasters. We will see more of these, and we indeed see a lot of them last year. So we need to have the energy transition taking place. That will require intelligent, efficient, effective investment in basically infrastructure projects that will accelerate this transition. With these projects, we think that there will be more jobs available. And of course, anytime you think about the world transition, that comes with certain challenges. But at the end of the day, these types of challenges did take place in history. This is a major, basically, transition. And we are optimistic that actually by undertaking the necessary green infrastructure projects, we can elevate the growth rate.
While reading this report, somehow this kind of like a big picture comes to the mind that on the one hand, inflation is coming down in most of the parts of the world. Monetary policy is easing in many parts of the world. But at the same time, because geopolitical risks are so high, the interest rates still remain high. And in some poor countries, they are higher than ever. What type of picture is that for the globe?
So the good news is that inflation has been coming down and without triggering a sharp increase in unemployment despite record high interest rates. So central banks reacted to the inflation challenge by increasing interest rates. In normal situations, you expect, the economies to slow sharply, and unemployment to increase. That has not happened, and hopefully it will not happen this year either. We will see a softer, transition to more normal growth while interest rates coming down. The challenge is that real interest rates, in other words, the inflation-adjusted nominal interest rates, remains high, and in all likelihood, they will remain high for the foreseeable future. What does that mean? It means that for countries that have large levels of debt, servicing that debt is going to be costly. And when we think about the weak growth outcomes and the slowdown we see in the global economy, against the background of weak growth and high real interest rates, obviously carrying debt is going to be more difficult, paying back debt is going to be more difficult, financing conditions are going to be tight. So on the one hand, there are good news. Inflation has been coming down, and in all likelihood, central banks will start reducing interest rates. But at the same time, the real interest rates, the inflation-adjusted nominal rates, will remain high for the foreseeable future, and that has consequences, especially for those countries that are vulnerable with high debt levels. And that's something for us very, very concerning.
It is logical then to see what the World Bank recommends the world. It says that, focus on investments, on drawing investments, because probably the competition will be high for those investments, higher than ever, on the one hand. And on the other, it suggests that countries need to stick to the more prudent macroeconomic policy, and it's better if they have some kind of framework, macroeconomic framework to develop and to grow further. Please elaborate a little bit on those two main recommendations.
So when we look at countries over a very long period of time, since 1950, what we have seen repeatedly, countries that have been able to increase growth of investment at a sustained level for a protracted period of time. So you just not increase investment for 1 year, 2 years, you are able to increase the growth of investment for 6 years or more. You end up seeing significant growth dividends. Not just growth increases, it increases, the productivity growth, it improves fiscal positions, it attracts foreign direct investment from outside. But more importantly, for countries to basically deliver these types of growth rates, it is essential for them to take care of their fiscal houses. That means having a medium-term plan, how they are going to address deficits and debt. That means improving institutions, property rights, providing an environment for the private sector to flourish, and of course, having the workforce, educated workforce, critical to attract foreign direct investment. So indeed, fiscal policy frameworks are important to basically start as the first step to think about how to accelerate investment growth. Beyond that, monetary policy frameworks also should be improved. And of course, financial policy frameworks, regulation and supervision has to be improved. When you think about all of these together, what is necessary? A comprehensive package of policies. Countries have delivered sustained investment growth over a period of time, and they have seen major dividends associated with that investment growth. Our hope is that they will put together the types of comprehensive policy packages that will trigger these types of investment booms with significant macroeconomic and development gains along with them.
Just to see what type of weight does the global economic slowdown have on specific countries. I know you cannot comment specifically on Georgia, and I'm not, of course, asking that. But do you think that the record of moderate or high economic growth could be a competitive advantage for the country? Could these countries be like more resilient to this global slowdown? Could we say that?
It's important for countries to have strong policy frameworks, a diversified set of growth engines. Of course, trade is critical for many developing economies, but it's important to, have the kind of the domestic market functioning well. It is certainly a challenging external environment for developing economies in terms of the trade growth, in terms of financing conditions. But we believe that with strong, robust policy frameworks, well-defined, very well-articulated fiscal and monetary policies, countries can deliver growth and deliver high growth rates. This will require credibility of, institutions. This will require basically having a well-defined, big picture, comprehensive policy package. We articulate these issues in the context of fiscal policy as well as investment booms in the report.
Would you say that, for example, IMF's involvement in countries and supporting this fiscal framework? Because if we look at the developing countries, in most of them, IMF is present at some point, right? Do you think that is something that global investors would look at? Would that bring up like their confidence into countries or credibilities of these frameworks?
I think at the end of the day, we need to look at country-specific conditions. If countries are working with international organizations, there are certain reasons involved, and this is up to country authorities to determine. And if it is in the best interest of the country, and country authorities see that there is value associated with or working with international organizations, they will, of course, take the necessary step accordingly.
To continue this line of the differences between developed countries and developing countries, what is the main difference in terms of impact?
I think the big difference is that when we look at advanced economies, obviously there was the tightening cycle that started in 2022. The impact of tightening cycle has been increasingly felt. So we are expecting growth to slow down in advanced economies from last year to this year. In the case of emerging market and developing economies, there is obviously a slowdown taking place in China that has repercussions for these economies. Taking out China from the emerging developing economy group, these economies have been performing relatively resiliently thanks to the types of policies they put in place. So there is slowdown around the world, more in some places than others, but the likelihood of soft landing has increased.
And what is the main message of the World Bank for us here in Georgia, for the world? Can boosting investment and strengthening fiscal policies help us turn the tide, or are we too late?
It is going to be important to basically have a comprehensive package of policies when it comes to accelerating investment growth. And that package of policies has multiple legs: fiscal policy, monetary policy, financial policy, structural policies, especially in the context of institutions. These are going to be all critical. When we think about the kind of the record of developing economies, and the types of cases we examine in the report, we have seen time and again, repeatedly, countries that have undertaken the policies have seen investment booms, and those investment booms have been associated with significant macroeconomic and development gains.
So we need more investment booms in the world.
As long as these investment booms are the booms in, efficient the projects, the transition projects when it comes to energy issues, of course, they will be associated with strong returns. Our hope is that when countries undertake investment, they will think about pros and cons very carefully. They will think about the types of jobs these investments are going to generate. Nevertheless, to say it is clear in this era there are multiple reasons why to push investment growth, whether that's going to be investment domestic originating or bringing foreign direct investment to a country. The investment brings the augmentation of capital, helps accelerate productivity growth, and obviously creates employment.
Thank you, Mr. Ayhan, for this very, very interesting interview. Thank you so much for being with us and taking your time once again.
Thank you.
The Checkpoints is presented by pharmaceutical company GM Pharma.